A married couple, both professionals, both earning well. Combined income, $280,000 a year. They did everything the internet told them to do. They maxed out their IRAs every single year, contributed diligently, converted using the backdoor method, checked the boxes. Then their tax preparer ran the numbers. $6,510 of their supposedly tax-free conversion, taxable, because of one rule they had never heard of, sitting quietly inside the IRS code, waiting. That rule has a name. And it has cost high earners billions in unexpected tax bills because nobody explains it until after it's already happened. Today, I'm going to show you 3 places where the IRA system extracts hidden tax costs from people who earn too much, and the specific framework for positioning yourself so none of it catches you by surprise. Welcome back, everyone. What we do here is take the parts of personal finance that get explained wrong or not explained at all and pull them apart until they make actual sense. Today's topic is the Roth versus traditional IRA debate. And I know what you're thinking. This has been covered 1,000 times. Every personal finance channel has a version of this video, but almost none of them go where we're going today. Because the usual explanation of this choice, pay taxes now with Roth, pay taxes later with traditional, is technically correct and practically incomplete. For people earning below $80,000 a year, that framing is probably enough. Make your choice, contribute, move on. But once your income crosses certain thresholds, the IRA system stops being a simple 2-lane road and becomes a 3-level structure with pressure points that your standard explainer video never touches. That's what this is about. I've structured this around what I call the 3-bill problem. 3 separate hidden tax costs that compound on each other for high earners, often simultaneously, often invisibly. Let's go. What high earners actually face when they open an IRA. Let me give you the actual numbers first, because most explanations skip over how sharp these cutoffs actually are. For 2025, if you want to contribute directly to a Roth IRA, the IRS has an opinion about your income. For single filers, the phase-out starts at $150,000 and ends completely at $165,000. Once you cross $165,000, you're locked out of direct Roth contributions entirely. Married filing jointly, the phase-out runs from $236,000 to $246,000. Cross $246,000 as a couple, and direct Roth contributions are not an option. For 2026, those numbers shift slightly, $153,000 to $168,000 for singles, $242,000 to $252,000 for joint filers. The window moves, but the mechanism is the same. Now, the traditional IRA. This is where most people assume there's a clean escape route. I can't do Roth, so I'll just do traditional. I'll get the deduction, defer the taxes, sort it out in retirement. Here's the problem with that assumption. If you or your spouse is covered by a workplace retirement plan, a 401k, a 403b, anything like that, your ability to deduct traditional IRA contributions also phases out at higher incomes. For 2025, single filers covered by a workplace plan lose the deduction between $79,000 and $89,000. Married filing jointly, both covered. It phases out between $126,000 and $146,000. So at $280,000 combined income, like our couple from the opening, you cannot do direct Roth contributions. And you cannot deduct your traditional IRA contributions either. What you can do is contribute to a traditional IRA on a non-deductible basis. After tax money going in, tax-deferred growth, tax liability on the way out, which raises an obvious question. Why would anyone do that? The answer is almost nobody does it as a destination. They do it as a bridge, specifically as the first step in a backdoor Roth conversion. And this is where the 3-bill problem begins. Bill 1, the locked door. Why the tax system cuts you off exactly when your rate is highest. Here's the structural irony of the Roth IRA income limits that nobody seems to want to say plainly. The IRS restricts access to tax-free retirement growth at precisely the income level where tax-free growth is most valuable. Think about what the Roth IRA actually offers. You pay taxes on contributions now and everything that grows inside the account. Every dollar of compounding, every dividend, every gain is yours tax-free in retirement. No taxes on the way out. No required distributions forcing money out on a schedule. a completely clean exit. For someone in the 12% or 22% tax bracket, this is a nice benefit. Pay a small tax now, get freedom later. For someone in the 32% or 35% bracket, which is where $280,000 in household income sits, this benefit is enormous because every dollar they could shelter in a Roth isn't just growing tax-free. It's escaping the 32% bracket on the way out. And yet, that's the exact group the income limits are designed to exclude from direct access. Now, to be fair, the reasoning behind income limits is that Roth accounts are designed to benefit moderate income savers. The tax-free treatment is a policy incentive, and Congress decided high earners don't need the incentive. They have other tools. Whether that's the right policy call isn't something I'm here to adjudicate, but the practical effect is that the people who would benefit most from tax-free compounding are told they can't have it, at least not directly. This is Bill 1, the locked door. You're paying some of the highest marginal rates of your career, and the account designed specifically to protect you from those rates in retirement is, structurally, not available to you through the front entrance. The workaround exists. It's called the Backdoor Roth, but executing it without understanding the second bill is where things start going sideways. Bill 2, the poisoned well, the pro-rata rule, the tax bomb nobody told you about. Let me introduce you to two people. Not to make a point about discipline or habits, just to illustrate a math problem that has a very specific consequence. Kwame is 38. He earns $195,000 as a senior product manager. He's been diligent with his 401k and, years ago, rolled over an old employer's 401k into a traditional IRA. That rollover IRA currently holds $93,000. All pre-tax money. He reads about the Backdoor Roth strategy. It sounds perfect. Contribute $7,000 to a traditional IRA as a non-deductible contribution, then immediately convert it to Roth. Since he already paid taxes on the $7,000, the conversion should be tax-free. He does it in February. Feels good, then he files his taxes. His CPA shows him the math. Because of the pro-rata rule, here's what actually happened. His total IRA balance at year-end, $100,000, $93,000 pre-tax rollover, plus $7,000 new after-tax contribution. After-tax percentage of his total IRA, 7%. When he converted $7,000 to Roth, the IRS doesn't let him choose which dollars he converts. The conversion is treated as coming proportionally from all his IRA money, 93% pre-tax, 7% after-tax. So, 93% of $7,000 equals $6,510 is taxable income. At his marginal rate of 32%, that's approximately $2,083 in unexpected federal taxes. For a supposed tax-free move, only $490 of his $7,000 conversion was actually non-taxable. This isn't a gray area or an interpretation. This is the IRS code. Publication 590-A and Form 8606 govern it explicitly. The rule exists to prevent people from selectively converting only their after-tax contributions while leaving pre-tax money untouched, which would let people bypass taxes they legitimately owe. But it has a devastating side effect. Anyone who rolls over a 401k from a previous employer into a traditional IRA, which is extremely common, often the default recommendation people receive, has poisoned their ability to execute a clean backdoor Roth. And here's the part that makes this particularly sharp. It doesn't matter if your IRAs are at different financial institutions. Fidelity, Schwab, Vanguard. The IRS sees your entire IRA landscape as one combined pool. The numbers on Form 5498 and 1099-R don't let you hide pre-tax money at a separate custodian to avoid the calculation. Now, meet Diana. Same income range as Kwame, same backdoor Roth plan, but Diana never rolled over any old 401ks into IRAs. Her traditional IRA has a zero balance when she starts. She contributes $7,000 as a non-deductible contribution, converts it to Roth within days. The entire $7,000 is after tax. There's no pre-tax balance to create a ratio, and the conversion is exactly as tax-free as the strategy promises. Same income, same contribution, same year, two completely different tax outcomes. The difference wasn't effort or discipline. It was the presence of a rollover IRA that Kwame's previous financial advisor recommended as a smart move years earlier, without ever mentioning it would complicate a backdoor Roth later. This is Bill 2, the poisoned well. And the deeper problem is that millions of people have rollover IRAs sitting in accounts they barely think about, not realizing that balance is actively working against their ability to access Roth benefits cleanly. Tax advisors who see this describe it as one of the three most common and costly mistakes high-income earners make in their retirement planning. Real quick, if you're watching this and the numbers are clicking, this is what Profit Plot does. No padding, no filler, just the actual mechanics of how this stuff works. Subscribe right now if you haven't. Click the bell. The next video will be exactly like this one. Back to the third bill, which is the one most people don't see coming until they're already in retirement. Bill 3, the forced harvest, required minimum distributions and the tax bracket you didn't expect. Here's the promise the traditional IRA makes. Defer your taxes now. Pay them later when your income is lower in retirement. For a large portion of people, this logic holds. If you're in the 32% bracket today and you'll be in the 22% bracket in retirement, deferring taxes is a genuine win. You get the deduction now at the higher rate and pay the obligation later at the lower rate. But there's a version of this story that plays out very differently for disciplined, high-earning savers, and it unfolds at age 73. That's when required minimum distributions kick in for traditional IRAs. The IRS, having given you decades of tax deferral, now requires you to start pulling money out on a schedule they determine. Every year after 73, you must withdraw a minimum amount calculated by dividing your account balance by an IRS life expectancy factor, and those withdrawals are fully taxable as ordinary income. Now here's the compounding problem for successful high earners who've been contributing to traditional IRAs for decades. You didn't just contribute $7,000 a year. You also contributed the maximum to your 401k every year. Your accounts grew because you started early, stayed invested, and let compound interest work for 3 decades. By the time you hit 73, you might be looking at $1.2 million, $1.8 million, $2 million across your pre-tax retirement accounts. The RMD on a $1.5 million traditional IRA at age 73 using the IRS Uniform Lifetime Table is approximately $57,700 per year, mandatory, whether you need the money or not. Now layer that on top of your other retirement income, Social Security benefits, maybe pension payments, maybe dividend income from a taxable brokerage account. What looked like a lower tax bracket in retirement scenario has turned into combined income that pushes you solidly back into the 22% or 24% bracket, sometimes higher. But here's where it gets genuinely painful, and Charles Schwab's research flagged this specifically. The RMD income doesn't just affect your direct tax rate, it triggers a cascade. First, more of your Social Security benefits become taxable. Up to 85% of Social Security income can be taxed, depending on your provisional income, and RMDs count toward that calculation. Second, Medicare IRMAA surcharges. IRMAA stands for Income-Related Monthly Adjustment Amount, and it's the premium increase Medicare charges high-income retirees. If your income in retirement crosses certain thresholds, your Medicare Part B and Part D premiums jump significantly. Couples with income over $212,000 pay substantially more for the same Medicare coverage than couples just below that number. RMDs can push you over those lines. This isn't theoretical. It's a documented phenomenon in retirement tax planning circles. Third, you cannot control the timing. The distribution happens on the IRS's schedule, not yours. If markets are down, you're still selling. If you have an unusually high income year from something else, a property sale, a consulting windfall, RMDs add to that pile regardless. This is Bill 3, the forced harvest. It's the compounding consequence of decades of pre-tax accumulation arriving at the exact moment when you're living on fixed income and tax efficiency matters most. And the brutal irony is that it's entirely legal, it's entirely predictable, and the people most exposed to it are the ones who followed the most conventional retirement advice. Maximize contributions, defer taxes, let it grow. How to think about all 3 bills before they arrive. All right, 3 bills. Let me give you the framework for thinking about each one. This isn't a playbook. Your specific situation involves tax rates, account balances, employer plan rules, and estate considerations that require an actual professional. But understanding the structural moves available is what lets you ask the right questions when you're in that meeting. For Bill 1, the locked door. The legitimate workaround exists. It's called the Backdoor Roth IRA, and as of 2025, it has not been eliminated by Congress, despite attempts in 2021 and 2022 to do exactly that. The mechanism is straightforward. Contribute to a traditional IRA on a non-deductible basis, then convert to Roth. The contribution limit for 2025 is $7,000, or $8,000 if you're 50 or older. For 2026, those limits increase to $7,500 and $8,600 respectively. Do this correctly, and you've accessed Roth's tax-free growth despite being locked out of direct contributions. Do this without addressing Bill 2, and you're potentially paying unexpected taxes on what you thought was a clean conversion. One important note from current research: starting in 2026, high earners making over $150,000 in FICA wages from the employer sponsoring their 401k are required to make any catch-up contributions on a Roth basis. This is a secure 2.0 mandate. It doesn't directly affect IRA backdoor contributions, but it's changing the overall Roth versus pre-tax math for high earners in ways that will compound over the coming decade. For Bill 2, the poisoned well. Two primary paths to clean up a pro-rata problem. Path A, roll your pre-tax. Traditional IRA balances back into your current employer's 401k, assuming your plan accepts incoming rollovers, which many do. Employer plans are tracked separately from IRAs for pro-rata calculation purposes. A $93,000 rollover IRA that moves into your 401k no longer pollutes your IRA pro-rata math. Your IRA starts at zero. You make the $7,000 non-deductible contribution, convert it immediately, and the conversion is clean. This requires your 401k plan to accept reverse rollovers. Check your summary plan description or call your HR benefits department. More plans allow this than people realize. Path B, if you can't roll back into a 401k, the alternative is a complete Roth conversion of your entire traditional IRA balance, pre-tax money and all. Yes, you'd owe ordinary income tax on the full pre-tax amount in the year you convert, but once that account is zeroed out and in Roth, every future backdoor contribution and conversion is completely clean. The one-time tax cost buys you the permanent ability to access tax-free growth through the backdoor route. This math makes more sense in years when your income is temporarily lower, a sabbatical, a career transition, an early retirement year, a year with significant deductible losses. The critical administrative piece that almost everyone misses: file IRS, Form 8-606 every year that you make a non-deductible traditional IRA contribution. This form establishes your basis, the after-tax money that shouldn't be taxed again on withdrawal. The IRS assumes all traditional IRA money is pre-tax unless you document otherwise. If you fail to file Form 8-606 and you eventually withdraw or convert without basis documentation, you will be taxed twice on money you already paid taxes on. Professionals who work with high-income clients describe this as one of the most consistently repeated, most preventable, and most expensive tax mistakes they see. Keep those Form 8-606 forever, not for 3 years, not until you retire, forever, because you may need them to prove basis to a beneficiary who inherits the account decades from now. For Bill 3, the forced harvest. The most effective structural tool here is what's called a Roth conversion ladder, a strategy of systematically converting pre-tax IRA money to Roth in the years before RMDs kick in. Here's why that window matters. Most people hit a lower income period between when they retire and when RMDs begin at 73. If you retire at 62 and Social Security doesn't start until 67, you have potentially 5 years of reduced income where your marginal tax rate may be lower than it was during your peak earning years. Converting portions of your traditional IRA to Roth during those years, even though you pay tax on the conversion, reduces the balance that will eventually be subject to mandatory RMD. Smaller pre-tax balance at 73 means smaller required withdrawals, which means least forced income hitting your tax return every year. Every dollar you convert during that low income window and move into Roth is a dollar that grows tax-free going forward, has no RMD requirement during your lifetime, can be inherited by beneficiaries without a mandatory 10-year distribution if structured correctly. The conversion doesn't have to happen all at once. The strategy is to identify how much room you have in your current tax bracket each year and convert up to, but not exceeding, the top of that bracket Year after year, you're gradually moving the balance from forced distribution territory into permanent tax shelter. The tricky part, and this is worth noting explicitly, conversions add to your income in the year they happen, which means they affect the same IRMAA, Medicare calculations, and Social Security taxation thresholds I mentioned earlier. You're essentially choosing between a tax cost now that you control and can time versus a tax cost later at 73 that you cannot control and cannot time. Most financial planners who specialize in this space argue that the controllable cost now beats the uncontrollable cost later, but the specific math depends on your account balances, your projected Social Security benefit, your state tax rate, and your expected longevity, which is why this is a conversation to have with a CPA who can run actual projections, not a decision to make based on a YouTube video. I mean that seriously. This channel is for understanding the landscape, but this particular decision has real consequences that vary based on your specific numbers, and the people who execute these strategies most successfully are the ones who model them properly before they act. What this conversation is actually about, there's something worth naming explicitly about why this topic doesn't get covered the way it should. The Roth versus traditional question, when it's explained for a mass audience, gets simplified down to, do you expect to be in a higher or lower tax bracket in retirement? Pick accordingly. That's not wrong, but it's a question that assumes your IRA choice exists in a vacuum, that you can just pick one lane, drive straight, and arrive at retirement without the road changing on you. For high earners, the road changes 3 times. It changes when your income rises above the Roth contribution limits and you lose direct access to the account that would benefit you most. It changes when you try to access Roth through the back door, but haven't cleaned up your pre-tax IRA balances, and an obscure rule converts your tax-free move into a tax liability. And it changes at 73, when decades of pre-tax accumulation becomes a mandatory income source, arriving on the government's schedule, affecting your brackets, your Medicare costs, and your Social Security tax exposure simultaneously. None of these are traps in a malicious sense. They're features of a tax code that was designed with competing goals, incentivizing retirement savings, maintaining tax revenue, and trying to limit windfalls for top earners. And the interaction between those goals creates friction points at higher income levels. Understanding where the friction points are is what separates people who navigate this cleanly from people who navigate it expensively. Let me bring this back to something concrete. If you earn above the Roth IRA income limits, above $165,000 single or $246,000 married for 2025, you have 3 things worth confirming before you make any IRA move. 1. Do you have any pre-tax traditional IRA balances, including rollover IRAs from previous employers? If yes, understand your pro-rata exposure before you attempt a backdoor conversion. 2. Does your current 401k plan accept incoming rollovers? If it does, rolling pre-tax IRA balances into your employer plan is often the cleanest path to backdoor Roth eligibility. 3. Have you projected what your RMD forced income will look like at 73? If the answer is a very large number, the window between retirement and 73 is valuable real estate for strategic Roth conversions. Most people waste it, and across all 3, confirm that someone is filing Form 8606 every year. You make a non-deductible contribution. If your tax preparer has never mentioned this form and you've been doing non-deductible IRA contributions, ask about it specifically. The cost of fixing a Form 8606 problem retroactively is much lower than the cost of being taxed twice on the same money. The Roth versus traditional question isn't just a philosophical one about now versus later. For high earners, it's a structural question about which accounts you hold, how they interact with each other, and what rules govern their behavior at different life stages. Most people make this decision once and move on. The people who get the most out of their retirement accounts revisit it as their income evolves, their accounts grow, and the rules change around them. Here's what I want you to do in the next 24 hours. And I'm being specific intentionally. Log into wherever your IRA accounts are held. Look at the account type, traditional, Roth, or rollover. Look at the balance. If you see a traditional or rollover IRA with pre-tax money in it, and you're above the Roth income limits, you now know exactly what question to bring to a CPA. That's it. One login, one look. 15 minutes of awareness that could save you a tax bill you didn't see coming. If this broke something open for you, subscribe. Profit Plot drops a new video every day. Every one of them is built the way this one was. Real research, real numbers explained the way a knowledgeable friend explains things, not the way a financial product brochure does. Drop a comment telling me which of the 3 bills surprised you most, the locked door, the poisoned well, or the forced harvest. I read everyone. I'll see you in the next one.